Ladies and gentlemen, we had yesterday someone describing the period that we are enjoying right now as a situation of more oil, less money. And in fact, in one of the interviews that Mr. Tillerson gave earlier this year to one of the publications of Energy Intelligence, he pointed out that the oil sector has enjoyed a period of very easy money. Now, the question is, does that period come to an end? Has it come to an end? And what are the implications for the oil and gas sector? We have, to discuss that, we have an excellent panel today. We have three banks from representing international bankers, representing international banks from across the globe. We have Julian Mylchreest from Bank of America, Ian Catterall from Bank of Tokyo, and Mike Powell from Barclays. And also to represent and to give the view from the capital markets, we have David Staples from Moody Investment Services. The four main themes that we would like to discuss are, first of all, what is the situation of the the major oil companies in this environment, particularly those who operate internationally. Secondly, we would like to discuss what the implications are for raising finance for major projects worldwide, if there are still any. Thirdly, we zoom into the oil and gas sector in the United States, in particular the shale oil situation, and what in particular their financial situation of some of them who are in difficulties. And finally, from there, from the smaller independents back to the large oil exporting companies, what does this all mean for the credit rating and the financial conditions of a lot of major oil exporting countries? Without losing too much time, I would like to give the floor to Julian Mylchreest to kick off on the situation for the big internationally operating oil companies. And I think we have a slide here that describes the situation they are in.
Good morning, everyone. And thank you, Jan. Let me begin by saying, look, it's a pleasure to be here again at this conference. I think, look, yes, these are challenging times for the sector, but as Churchill once said, in every challenge, there's also an opportunity. So, and I think, look, for sure, when we look at the sector today, I think the best way of framing it is, as we'll talk today, there is plenty of liquidity in the bank market and in the capital market still, but I think the gap is widening dramatically between the haves and have-nots and the sort of quality players and the weaker players in the sector. And to the piece that Jan's asked me to talk about in terms of the majors and the IOCs, I think that for me is actually the opportunity in the challenge for the majors as you look ahead. And the slide on the screen that Jan's put together frames the question, I think, well. Look, for many of the majors and indeed for most players today, yes, cash flow is not actually covering capex and dividends. That said, whilst I think when you look at that slide, and it's an acute issue for the smaller players, which is a topic we'll be coming back to in terms of views on the US market, I actually do think it's overdone as a sentiment when it comes to the majors. I think the question comes in the sharp focus with the majors because of the absolute focus in the stock market today on dividends. Right or wrong, investors are cautious about returns and are more cautious actually than the street and brokers in my firm or than most of the companies in this room on oil price. And sentiment, frankly, towards the sector is as miserable as I can remember in terms of public market equity investors. I mean, at Bank of America, we've been keeping a survey of fund managers for about 20 years. And if you look at that, the underweight towards the sector is 3 standard deviations worse than the average. It's the worst on record in 20 years. So that tells you kind of the investor sentiment. And as a result, I think for the majors, the investment proposition as far as investors are concerned is dividends, 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 because that's cash and they can feel comfortable with that, whereas they're not comfortable with the broader play on the sector. And look, as a result, I think there's been a shift in the kind of waterfall and the kind of the way majors, I think of the priorities for cash. After debt first service, I think used to come capex and then dividends. I think if you look at now, because of that investor caution, frankly, on the model and caution on the macro, dividends have actually been pulled up the waterfall. So it's sort of debt service, probably dividends ahead of capex, and that then comes into sharper question of, well, how's the capex being funded given dividends are having to sit further up in that waterfall? And you saw Shell in particular make that explicit in their Q2 numbers. So in a way, I think you've always got a position where the majors are almost competing with each other to show investors how much they value the dividend by cutting capex the most. And that's it's a slightly strange place for the market to have taken the industry, but I think it's reality. However, look, whilst short term, I think in reaction to the oil price drop, you've seen a pause in FIDs and explicit statements by the likes of Total and Shell and a switching off of capex. My own view is actually that for the majors, disposals and debt access will in the years ahead actually fill the gap. So ultimately, I think the industry will keep investing more cautiously and selectively, but still investing. Plus, over time, I think what we all probably know in the sector is that margins do ultimately adjust, and the net margin the industry earns is actually not that different at $30 oil than $100 oil. And what you need is to bridge to the point where that equilibrium comes back, which I think, again, the majors are a better place to deal with than some of the smaller players. So look, all that's not to say that I think from our perspective, we think you should be complacent, but rather to say at the quality end of the majors as a group, I think they actually have the luxury to pull a lot of levers to bridge to that adjusted world where margins adjust and or, if you heard some of the more bullish comments yesterday, oil prices maybe recover at least to 60, 70 on a sustainable basis again. And why do I say that? I think, look, first, they have the best and cheapest debt access, even today. Second, I think they have a large portfolio of FIDs and capex and approvals to manage, delay, realign. Third, they have, I think, a strong hand with the service companies. And lastly, they have a deep portfolio of assets from which to actually sell. And just to elaborate briefly on that last point before I hand back to Jan, I think the real strength of the majors is that they have assets to sell in the downturn that tap into different pools of capital. If you're an independent today, all you have to sell are upstream assets to other upstream players that are feeling the pinch. Whereas I think the diverse portfolio of the majors means they can actually tap into buyers that are strong and hungry for their non-upstream assets. So that's into the appetite for infrastructure investors today, and what I think we now in banking are more calling infra plus, where they're taking, frankly, more risk than infra players used to. Strong private equity demand for terminals, pipes, chemicals, the forgotten assets buried within the majors, and access to the MLP market, whereas you see the volatility, but I think the MLP market is still wide open for quality names with quality stories. So look, in summary, I think capex has shifted down the waterfall, and yes, there is a shortfall, but I think the majors are actually mostly well placed to work things through. And therefore, speaking personally, when I look at the dividend yields of the majors today, I think in many cases, and it's not a view of my research analyst at my firm, but I think in many cases, my view is that those yields are actually unsustainable and wrong rather than that the dividends aren't safe, because I think A, dividends are being prioritized, and B, the majors have got quite a lot of flexibility to manage through several months of stress. So my thoughts. Yeah.
Well, I think let's move on directly to the world of project finance. You mentioned, of course, the capital expenditures, but of course part of them have expenditures as far as they continue to invest in mega and large projects, of course, have to be financed. And I would like to give the floor now to Ian Catterall to comment on the world of, in particular, project finance and what the new economic environment means and financial environment means for major projects going through and how they are being funded.
Thanks, Jan, and good morning, everybody. I think the good news is that from the bank's perspective and from the banking market, there is liquidity out there in the market. You are seeing the number of banks who are able to lend long-term for project finance. And by long-term, you're looking at, let's say, 10, 15, 17, 18 years. It is increasing. A number of banks that are pulled out of the market have now come back. So overall, you're seeing the Japanese banks have been very active and relatively aggressive over the past 3 to 4 years. French banks are now coming back in, and if you look at the league tables in various publications, you will see those banks are coming further up that league table. And you're also starting to see, on a selective basis, the German banks and the Dutch banks coming in as well. And then you have the likes of HSBC, who are very focused on this as a product. So I think the good news is that, that there is liquidity. Our view is that that is likely to be sustainable in the short to medium term. I'm not quite sure why banks are doing it, but most of them seem to be ignoring the impact of Basel III. Basel III, intuitively, you would think would have a negative impact on long-term project finance lending, but it doesn't appear to be the case. I talk to my infrastructure colleagues, and they tell me that maturities in the infrastructure market are now in excess of 30 years, which I was a little surprised at. So, you know, there is a growing band of banks who will start to look at 30-year maturities, which is interesting. And again, you have, I think as Julian mentioned, you have institutional investors as well, who are starting to come into the market and co-lend alongside the traditional banks, and they are quite happy to take long-term maturities. They haven't quite reached the oil and gas market yet from a debt perspective, but I think there's just a question of time, and I think they will once they get comfortable with the risk profile. You are also seeing private equity investors stepping in to buy the midstream assets as well, and banks are comfortable to lend into those projects. You're seeing Arclight buying midstream assets from Total, and they are in the market at the moment to raise debt for that. So, and they will achieve that relatively comfortably. I think US dollar funding costs for the banks are increasing slightly, and I think you will see that as a continuing trend over the next few months. I don't think that will impact liquidity. It may impact the pricing and the terms and conditions that borrowers are able to achieve, but we don't see it having a particularly negative impact. A lot of the European banks are very, very liquid in euros because of the ECB's current quantitative easing, and that gives them a tremendous competitive advantage in terms of how they can compete against the non-European banks. And I think one of the most interesting things we're seeing is the Chinese banks coming into the market. They are, on a selective basis, incredibly aggressive, both in terms of the amount of debt that they will lend to individual projects, but also the pricing that they will bid. They will quite happily undercut most traditional project finance banks. They will lend 100% of the debt if you ask them. The recent Golar have announced, I think it was last week, that Chinese banks or Chinese institutions have financed their first GoFlex floating LNG project in offshore Cameroon with Perenco. And that's a very good example of how the Chinese banks are starting to flex their muscles on a selective basis. I think that we are, having said that there is liquidity in the market, there's always the other side of the coin, and I think the other side of the coin is that who is that liquidity is available for? And I think that's an interesting question. So I think my feeling on that is that good projects will always be able to raise debt, always be able to raise the finance for them. I guess the question is, what is a good project in the current context? And I think for the lenders, it always goes down to the economics. Does a project work at a particular oil price? Does a project work at a particular gas price? And I think if shareholders or sponsors, developers can demonstrate that the economics work, the fundamentals of the project work, that underpin the reason for developing it and investing, then I think that the money will follow those particular projects. So I think the next wave, certainly from my perspective, of projects to be financed, we're starting to look at Mozambique with the two projects coming there. Interesting how the shareholders are following slightly different models in terms of the ENI-led consortium going for the floating LNG option, whereas the Anadarko consortium going for the traditional land-based LNG trains. So I think in conclusion, lots of liquidity out there for the right projects, interesting investors coming in from China, potential for institutional investors to come in due course. And I think for the right project, the money should be there.
Ian, you mentioned liquidity. Liquidity back in the market. And you also touched on Basel III. Now, your opinion is clear. You say, well, it shouldn't be a problem. Long term, I mean, more than 10, 20-year lending in the marketplace should not be a major concern. But do we all agree on that? As a Japanese bank, you have a different view, perhaps, than...
No, I think that's fair comment. But we have seen, and if you look at the league tables, as I said, in a number of magazines and publications, you will see that the BNPs of this world, the SGs of this world, having dropped out of the league tables in 2010, 2011, are now pretty much back there at the top in the traditional positions that they've held previously.
Well,
so
this was traditionally a market for the European banks. Yeah. Mike, what is your opinion about it?
Yeah, I think last year, Jan reminded me, I talked about an Indian summer for bank liquidity. And given the weather we've had in London, it strikes me we're still in a bit of an Indian summer. I'm skeptical that banks will continue to be able to lend long-term to projects and believe that's the best use of their capital. I think the regulatory headwinds, Basel III in particular, are very powerful. Ian alluded to some of the tailwinds at the moment that provide funding and there's for banks, particularly in euros, and there's very limited number of lending opportunities for banks. So they are underlent today, but as we roll forward, it's conference season across sectors, and we had a financial institutions conference last week in New York, and one of the themes there was that from investors was that they expect to see a wave of capital increases, equity issuance out of the European banks. So today the banks are behaving as if they have liquidity, but I think in the future we're going to see regulatory pressure making it tougher for them to make long-term lending work from a return on equity point of view.
If that would be true, of course, the importance of the multilateral agencies, the World Banks and the IFCs of this world will become more important, as is as a source of funding the role of the export credit agencies. There are two interesting developments this year. One of them is in the United States, and the other one is in China. Maybe, Ian, you can comment on that?
Yeah, I think the interesting issue in the US is whether US Exim will be reauthorized. I'm sort of looking at it from a distance, and I'm assuming that at some stage it will stop being what seems to me to be a political football, and that it will be reauthorized. I think I will be pretty shocked if it isn't, but perhaps not surprised if it isn't. And then I think the Chinese banks, as I've already alluded, and the Chinese ECAs as well are being very aggressive in what they lend to and how much they lend. So I think that the ECAs are a very critical part of the liquidity and the funding solution out there. So you will see a vast array of ECAs involved in the Mozambique transactions, and without them they would not be able to be financed. But the ECAs are still as keen to lend into those types of transactions. And
we have a new player, new kid on the block, the Asian Infrastructure Investment
Yes,
Bank.
Yes, that's right. I mean, it remains to be seen to what extent they get to play in that kind of market. But yes, you're right.
For me, and the important thing about the ECAs and the government-sponsored lending institutions is they exist for a political agenda, whether that's to support exports or whether it's to support supply. And so if you are having to build a finance plan around export credit agencies, you need to think deeply about where you're going to procure your content, and that's going to shape your funding sources. And also to access Chinese funding, you may also need to be thinking about offtake and having significant Chinese offtake, also true of Japan as well. So it has a real commercial implication.
It does. It impacts on how you can develop a project. It impacts on your EPC strategies. It impacts on where you actually want to sell LNG, for example. And historically, we've seen a lot of the LNG buyers being asked to take equity or taking equity in the projects. It'd be interesting to see whether that carries on as the theme. But you're right. But these are $20 billion plus projects. They're very complex at every single level that you look at, and that's why they take so long to develop. That's why they are so important.
May I go back to Julian? Traditionally, big major oil companies, they love to hate project financing. Too cumbersome, too time-consuming, too much lawyers involved, and so on and so on. So if they can avoid it, rather they finance big projects on the balance sheet. Do you think that there will be a shift in that attitude, given the new financial environment we're in right now?
I think there'll be a modest one, but I don't think it'll be a radical one. I think an awful lot of the funding will still be done by the majors on balance sheet. So I think it would surprise me if there's a major shift in that respect.
I think the significant evolution, which Julian alluded to, in terms of an active asset market, is the emergence of private capital looking for midstream assets. So I don't expect, like Julian and I don't expect that the majors are going to suddenly espouse project finance as a financing tool that is magical for them. But I think we will see more of, as we did with Shell's MLP last year, the majors concluding that they don't have to own midstream assets to be able to deliver returns and control the value chain in the way they have in the past. And that's some of...
I agree. I think development capital will still be seen in project finance by the majors as expensive capital. But if once the project's built, you can sell to an infrastructure fund at 10, 12 times, then that's how you're going to recycle the capital and then put that in the next project, which actually you're best placed to deal with the risks and the uncertainties around.
You mentioned already the master limited partnerships initially for midstream assets. An interesting remark was made yesterday. I don't know whether some of you picked it up, but yesterday it was mentioned that Pemex, in fact, in Mexico, did a MLP financing to raise capital for its business. And so it indicates that, of course, also the majors have become more innovative and about how they raise financing for all their operations. As far as the big mega projects are concerned, of course, and maybe it also illustrates the enthusiasms of the big banks, is that, of course, the number of mega projects this year has dropped. We have seen deferrals here in the graph. You see it of, well, depends on whom to believe, but about 180 billion to more than 200 billion US dollars. And so, of course, that makes the number of financing opportunities for the banks, project finance opportunities, less. But of course, I think to conclude there, yes, continue as usual, new players on the block as far as project financing is concerned. But for a lot of mega projects, the message is deferral or back to the drawing board and please take your time, I would say. Now, this is a description of the situation worldwide in the international arena, and I would like to zoom in to the US shale oil situation. Because if it's true that what some people say is that the US shale oil sector has become or is becoming the new swing producer, I can imagine that what is happening there will have a severe impact on not only the US oil sector, but also on the oil sector worldwide, and in particularly on price developments. So please, Mike, could you give us your views on what's going on in the United States right now?
Happily, Jan, thank you. Thank you, Will and Ryan, for having me back, and good morning, everybody. But at Barclays, we had our own energy conference in New York last month, which was a great opportunity to hear live from the US producers how they see the world. And there were a number of themes that came across very strongly. Number one, their focus on costs, improving efficiency, improving well productivity, as we know. Number two, living within cash flow. Now, they have a flexible concept of cash flow, and living within sometimes means selling assets to do so. But number three, that 8 out of the 10 largest unconventional producers are expecting to maintain or grow production next year at a $50 a barrel level, so doing more with less. So a very resilient message for the market. At the same time as this slide put together by Jan powerfully communicates, there's a lot of focus and concern about the amount of leverage in the upstream system in the US. I think about it as a capital structure that was really designed and a function of $100 barrel expectations and accessible capital markets. We estimate that the median leverage debt to EBITDA or free cash flow multiple for the E&Ps, the median in the US is 3.8 times, and there are 25 firms with leverage over 5 times. Those are not sustainable numbers. And because of the environment we're in, we're going to see leverage, so debt to EBITDA multiples increasing in 2016 from where we are. That's inevitable. So how do you reconcile those two data points? Well, a really important point is that 2/3 of US production is in the hands of investment-grade companies. Another 12% in the hands of BB, so just below investment grade. And between them, those are companies who have access to market. I think Julian was talking really about the haves and the have-nots. These are companies controlling 75% of US production who are quite confident that they will be able to survive these tough times. But then there are the have-nots. So let's talk a little bit about the predicament of the have-nots. The independent E&Ps conventionally borrow from two funding sources. They go to the banks and they go to the high-yield capital markets. From the banks, they borrow on a secured basis, so secured against barrels, in the US, barrels in the ground. And the debt is sized against the value of that future production today. And it's lent in the form of a reserve-based loan. We talk about them as RBLs, and the RBL, I will advance you, is a function of the net present value of your future production. The high-yield capital markets are unsecured debt, no financial covenants. The only obligation, really, is an obligation to pay when the debt falls due. And bear those two characteristics in mind as we talk through this. The banks, and there's talk in the market about the RBL redetermination process, they relook at debt capacity twice a year, in the spring and in the autumn, and we're in the middle, actually, of the redetermination season for the autumn right now. I remember talking last year around how price decks of banks, so the assumptions the banks apply for the future oil price, how they were thinking then, and it's really the same dynamic a year on, that when oil was $100, the long-term price was $70. The long-term price is now, we think, in this season going to be around $60. So the way the banks think, we didn't chase the market up, and we're not going to chase it down. I mean, $60 is really now pretty much in line with where the forward curve is. Now, that's long-term. There's an adjustment at the near end, which has a big impact because of the importance of your near-term production. We think that this environment is going to get an awful lot tougher, actually, next spring as opposed to now. So there will be companies who will be challenged in this cycle, but spring will be tougher for a number of important reasons. Number one, year-end SEC restatements, which are done on a lagging oil price and will result in some significant redeterminations of reserves at year-end, and those will come out in the spring. A decline in PDPs, a direct effect of how the US producers are tailoring their drilling strategy to the current environment. So drilling, as we know, has fallen off an awful lot, and people are focusing more on well completions. And also the roll-off of hedging. And we've been in an environment for the last few months where it's not been effective or economic for US producers to hedge. So looking to 2016, where usually we'd expect 1 year ahead probably to be 50% hedged, 2016 we calculate that hedging is around 25% for that peer group. So there's going to be a big fall off in their hedge positions. And the other factor around bank behavior here is, and I'll talk about it a little bit more in a moment, the banks do have quite large exposure to the E&Ps. What they don't want to do is create a portfolio or systemic issue for their own lending books. So they don't use the oil price as the tool necessarily to put pressure on companies. They'll focus much more on case-by-case granular conversations around reserves, production profiles, than use the oil price, which is a very blunt instrument, and you may have unforeseen, unanticipated consequences. One new factor in the mix in thinking about unforeseen consequences, and back to the portfolio exposure question, in the US, and it's only in the US, is the US regulators. So FDIC, the Fed, OCC have become very focused on bank exposure to US E&P. Their concern is this is a systemic issue waiting to happen. They're approaching it through a lens of what they think about as leveraged loans, and that was something that became a focus in response to private equity leveraging of buyouts about 18 months ago. And they apply that same lens now to upstream lending. Interestingly, they're not focused on oilfield services at all. It's all about upstream, and they're looking at the reserve-based lending books, focusing on the agent banks. Julian, I'm sure, is in the middle of this storm as a head of energy at an esteemed US bank. They bring a very different methodology. So the reason why the banks like the secured loan, they value the data against future production, is the recovery rates in distress are very high from that lending technique. The regulators are applying this leverage concept. They're assuming these are leveraged corporates, like any leveraged corporate, whether it be retail, media, whatever, and not really giving the credit for use of debt to invest in bringing oil in the future into production. So it's a very live issue, and it will be a significant factor in how banks, the US banks, banks operating in the US market, are going to think about every single lending decision. That could be a covenant waiver. It could be a request to allow a borrower to raise additional debt, not from the banks, but from elsewhere. It will affect banks thinking around whether they're prepared to sell high-yield bonds. So that's a very new factor. There's been quite a lot of talk about the size of bank lending books. Focusing on the lending books alone, I think, is a little bit misleading. I think you need to dig a bit deeper into the quantum of capital banks are actually providing to the sector to understand bank behavior, to understand the exposures that banks have. So what we did was a little bit of work to look at the size of, and you have to rely on the disclosures banks give, and everyone's disclosure is different, so it's always an apple and pears, but directionally, I think it is quite interesting. We looked at disclosed loans to energy companies compared to common equity bases. There was a story in the Journal a week ago about the US bank exposures, 40 billion, 50 billion for the big global US banks. That book is broadly in line with the large lenders globally to energy. But what stands out is if you look at the US banks, they have a fraction of the exposure relative to their common equity, to their real financial flexibility, as compared with the European banks. And when I say a fraction, think of a fifth. So I'd be focused a lot more on European bank exposure, where there's an enthusiasm to lend to oil and gas projects and being historically enthusiasm about the space, than I will be about the large US lenders. I would also, and Jan's always reminding me about what happened in the 80s, I would also be thinking about the regional lenders in the US, those with less diversified books. And maybe to tear up David a little bit, I'd be thinking in the emerging markets about banks who will have a high degree of correlation with the sovereign credit, particularly oil-producing countries. And I can't avoid thinking about Nigeria, where there was so much debt provided by Nigerian banks to finance indigenous companies acquiring assets from the majors at the top of the market. I mentioned high yield. The high yield market is largely closed for the non-blue chip, non-investment grade names. Volumes for the US are off 50% from last year. In the last 12 months, high yield investors in energy have lost 20%. So the market that's closed is that unsecured market I talked about. But you've got producers who need capital. And what's happening is that they're going back to high yield investors and borrowing on a secure basis. But the banks have that first charge, that first mortgage. Any of you have a second mortgage on your home will understand what I'm talking about. So the producers are giving second liens or third liens on their reserves and production to access the high yield market. So that market is selectively open. It's still expensive money. 10% is sort of the area where the deals that are being to market this year have priced. And what they're doing is, in most cases, actually not raising additional debt. They're paying down their reserve-based loans. In some cases, they're swapping that secured debt for unsecured debt to get their cost of debt down. The space to watch are those unsecured high-yield bonds, which are being pushed further and further down the waterfall in the event of financial difficulty or financial distress. I guess the third market that's really important for these guys, which the third market that's really important for these guys is the equity market. Equity and high yield markets had a bit of a dead cat bounce and opened in the second quarter. Those investors are all nursing losses now. We do still see that market open for the very best names, the very best plays, the right strategic story. But fundamentally, it's not there for anything that's second tier. Picking up something Julian said around investor sentiment, in Europe, we've seen next to no equity issuance. We have seen equity issuance in the US. In Europe, next to none. And I think there's a number of reasons for that. One is the willingness of investors to put capital to work in this space. Secondly, valuations. We think that US E&Ps are still discounting a mid-cycle oil price of $70 a barrel. So it makes sense to go to the equity market at $70 as opposed to selling assets off the forward curve. And the ability to raise equity overnight, which if you're UK listed, very tough to get access to significant equity without going through rights and the complexities of that. So it's a tough market. I think there are some signs that investor sentiment is changing, and we're seeing a shift from shorts to longs. But the way I'd summarize is when I think about those less advantaged producers, I think about them as the cartoon character who's run off a cliff and whose legs are still turning, and he's wondering how far it is to the other side.
Thank you. Briefly, before we move to David, Mike mentioned the regulatory environment and regulatory pressure in the United States. Is that something you can relate to as an American, representing an American bank?
Short answer, yes.
Yes. Okay.
No, look, I think Mike's already touched on the one lens through which the RBL book of all the US banks is being looked at by the OCC in particular, our regulator. I think the other bit which is also relevant is, in addition to the demands Mike's described, the regulator's also saying that the bank should not be taking account of hedging going forward, which if you kind of work that through, it's like, look, the long run view of how a bank should be thinking of a risk rating for a company should be on the basis of their long-term financial health rather than dictated by a short-term view which could disappear, and then you kind of should have been risk rating it in a different level before. What does that practically mean is that, look, if banks have a kind of 1 to 9 kind of risk rating, the difference between, as an example, being a 4 and a 6 is not linear in terms of the amount of capital we have to put behind that. So crudely, if you're seeing the risk ratings of a portfolio of a bank being pushed by the regulator down 1 or 2 notches, that's effectively meaning capital has to be taken away from somewhere in order to put that capital behind that to meet the risk rating that's dropped. What does that mean? Again, accentuates the have and the have-nots piece. So that's the call. And look, one final thing, I think on the haves and have-nots in terms of access to markets, I think the one thing which Mike didn't touch on, I think is also relevant, is even those that have access to capital, it's repriced significantly. So if you were borrowing at 6% a year ago, you're now borrowing at 12. You may still have access to the capital, but the repricing is significant, and therefore the number of projects you can do and the returns you can deliver are going to be more challenged.
Thank you. Well, let's move away from the United States and from the world of banking and go into the international arena and to the capital markets and how they view the sector, but not only the sector, but also the major oil-producing countries. But maybe in between, David, you've mentioned the independents in the US, but that's not the only part of the world where there are independents. You also have quite a few here in England and elsewhere. Can you say a few things about that as well, or?
Yeah, sure. The challenge is we're running out of time, so I'm going to try and keep mine very focused. On the independent side, there's a heavy linkage between sovereign and emerging market risk and many of the independents. People are familiar with the Afrin story this year, the default of Afrin. That was a complex capital structure, that was emerging market risk, that was, I think, a lack of transparency for some people on the structures underlying it. These are complex credits. You talked about Tulo and the RBL revaluation. They're facing, the challenges of operating in Africa and policy predictability and frameworks, and they're maneuvering that very well, but it's certainly raised challenges. And so if you move into the emerging market space and sovereigns, there are heavy interlinkages between sovereign health, sovereign strength, sovereign wealth, and policy predictability within markets. You look at the Gulf countries, they're very much at the root of the desire to maintain market share. And while they're, of course, facing fiscal constraints and have limitations on how much they can cut budgets because of social policy, they have the wherewithal through their sovereign wealth funds to absorb the shocks that the market is facing. You move into other countries like Russia, and Russia has a heavy reliance upon hydrocarbons. It does have wealth and it does have reserves, but it is now talking, about potentially taxing its public oil companies, publicly traded oil companies, which in a conference like this will impact investors. You mentioned Nigeria. The challenge with Nigeria and sovereign and emerging market risk is not just that it's Nigeria. It's not just that it's policy predictability in a market where we've been waiting for a regulatory regime for years. You've had an election, you've had a national oil company without a board, you have lots of questions. But the challenge there is also the financial sector. In each of these countries where there are stresses at the sovereign level, where there are fiscal pressures, and where there isn't the wealth to absorb the shock, the financial system, the banks run into challenges, and therefore the funding of indigenous projects. Now, projects in the Gulf region have benefited from huge liquidity. You look at the Qatari projects, the Abu Dhabi projects, they've done very well. Now, liquidity is drying up in some of the banks, but certainly not to the extent. So for me, when I look at emerging markets, I look at the oil sector, I think not just about the health of the sovereign to absorb shock, and the GCC countries, clearly it's there, to varying degrees, but it's there. When you look into Africa, the shock absorption capacity isn't there. Fortunately, the sovereigns don't have substantial debt obligations. But what is there is policy predictability. The governments need to address fiscal pressures. Where do they go? They go to their wealth, the natural resources that are being generated, whether it's the metals and mining sector or it's the oil and gas. And that's the problem from an oil and money perspective. From an investment perspective, you need predictability, you need long-term visibility. We don't have long-term visibility on pricing. We're back to the 2007-2008 period. But what you don't have in the emerging markets, which is very much a growth driver for investment in the oil sector, is policy predictability in some of these markets where 2 years ago we were saying great opportunity for oil, great opportunity for reserves, but the question is the policy predictability there for the investor? So we've got 3 minutes left.
Thank you very much for, let's say, your crisp remarks. I think we could also delve into the issue to what extent national oil companies are also now being used as a kind of conduit for governments to borrow money. I think that is also an issue that we may see more and more perhaps in the future.
Yeah, if I could just say one very quick thing. I think national oil companies are a policy tool. And so a country that needs to bolster its fiscal position is going to do so through their national oil companies. If they have the capacity to continue investing because of shock absorption capacity, they will. And that's why the Saudis and Abu Dhabi and other markets have been holding tight on production or holding firm on production levels. But I think that's the challenge.
I think without let's say, summarizing what has been said, I think it has been all very clear. I think maybe the big question is to what extent bank markets and capital markets will drive decisions in the oil boardrooms, and whether that perhaps indirectly also affects the oil that will be produced going forward, and therefore also have an indirect effect on oil prices. Who knows? But I would like to give the floor, let's say, I'd like to ask the floor for questions. I'd like to invite you to, if you have a question, raise your hand, wait for the microphone, state your name, and also tell us for whom the question is, to whom it is directed. Yes, please. Over there, and then we go to the gentleman over there. Okay?
Yes, Philip Rose from Energy Intelligence. I would have a question about the climate change risk, but rather than the actual impact of climate change on companies and projects, which is a long-term risk, rather than the impact of climate policies, which is a medium-term risk, my question would be on the short-term reputation risk that's related to climate. And as a former banker, I know it's increasingly taken into account by banks and most probably by investors. So I would like to know what you can say about that. Thank you.
When you mention oil in your credit committees, do you have competition from other people representing other sectors, or is that not a major issue? I don't know. Who wants to answer that one?
I think everybody's looking at me. I think most of the leading project finance banks all subscribe to the Equator Principles. And the Equator Principles are a set of guidelines that have been established alongside the World Bank, which govern how we expect to see projects developed and the environmental and social impact those projects will have. And it's remarkably detailed. It even goes down to, when you have 15,000 workers building an LNG plant in the Middle East, where do they live? What are the conditions under which they live? And I've actually been around some of the camps with the ESIA advisors. So I think from that perspective, the banks are very focused on that side of things. To what extent it impacts on climate change, I don't think that has really come into the bank's thinking yet. We certainly don't have that as a policy area for us. Having said that, intuitively, we don't really get involved in financing coal projects or coal-fired power stations. So I think that there isn't a particular policy that's out there, but I think we are guided by what we see going on in the world, and we're certainly guided by the Equator Principles for when we're developing the projects.
And I guess that also reflects the thinking at Bank of America and Barclays. So, yeah?
Yes, look, I think coal would be, in most cases, a no from our standpoint. And equally, I think at the other end of the spectrum, there's a big push from us and several other banks in terms of money going into new energy initiatives. So that's, I guess, the two places it currently hits rather than in the centre.
No, I think we have similar sensitivities over coal. I think you talked about reputational risk, and that's the lens that increasingly banks look at their activities through. So, Equator Principles is an important set of guidelines, but we will have our own judgments and sensitivities above and beyond that now.
Okay. There was one, and I think one final question over there.
Sorry, I have two short questions for Chinese bank. And the first one is like for ICBC, if they want to gain more market share in the infrastructure finance field in the global arena, do you think they should show more risk preference compared to our European bank, American bank, and the Japanese bank? And should they just focus on their business operation in emerging markets like Latin America or America? Or should they expand their business operation also in the European market and the American market? My second question is about how do you think of the role of the Islamic finance for the next decade in the infrastructure finance field? Thank you.
Very briefly, I think, Ian, the Chinese banks, and what advice can you give them?
I think that the Chinese banks are very capable of formulating their own strategy without ducking the issue too much. They're very active, and I think they certainly know what they want to achieve. Islamic financing is an interesting topic. I mean, to a certain extent, I think Islamic financing is. It's easy to put Islamic financing in, but does it actually increase the liquidity you have available? I think that's the question. And I think we are starting to see that happening on a more sustainable and deeper basis. And there are a number of institutions now that have been primarily set up to lend on an Islamic basis. And so that is providing additional liquidity coming into the market. And I think what you're also seeing is a lot of traditional banks such as ourselves, who are now setting up their own, getting their own Islamic licenses to be able to lend on a variety of bases, so that we will be able to tap into that market ourselves.
Yeah, I was just going to add, one of the challenges, we do a lot of ratings of Islamic bonds across a number of industries, and one of the big challenges with Islamic financing in project financing structures is the intercreditor relationship aspects and the complexity of documentation. We rate them, we look at them, we spend a lot of time on an Islamic financing instrument because there is not yet consistency the way there is in the bond markets across documentation. And every time you do one, you find something new or some new structure because it's still an evolving market. And that doesn't necessarily work well for project financing, where people want to have uniformity, where they want intercreditor understandings, and they don't necessarily want to be sharing risk of collateral or potential questions over security and asset pledges. But a lot of talk of using Islamic financing in project finance. But
well, on that note, then I would like to thank do we have time for one question? No, no, I'm sorry. You can ask, of course, the gentleman here afterwards about the particular questions you have. I would like to thank the panel, and I would like you to join me in also in thanking them for their comments.